Welcome to Wealth Matters Podcast. I have Yonah Weiss with me today. Yonah is a powerhouse with property owners' tax savings. As a business director at Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. And I want to talk about cost segregation today because I'm moving from small single family to multifamily, and I keep hearing about it. Of course, I kind of understood, but I have not yet applied the principles myself. And I have heard from so many of my listeners that they have similar questions. So I'm looking forward to this episode. So
my pleasure. Yeah, sounds good.
Yonah, what's your role in the business?
So my role in the business, actually in the business side of things, business development and the sales, as well as really education, because I found that so many people don't even know what cost segregation is. And there's so many questions and nuances that everyone, has to spend 15 minutes, an hour, half an hour on the call, just kind of explaining it. Well, what is this? How come my accountant didn't tell me about this? And I realized that, the platform of social media and podcasting is just an incredible platform and way to just really educate them. And it's funny because my background is as an education, as a teacher.
Oh, really? Nice.
So it kind of came naturally to me to kind of take on that role. So I don't actually do the accounting, engineering aspects of the job. We have a huge team of accountants and engineers that do that. And I get to do things that I'm better at.
Got it. So that's pretty interesting. And just to remind everyone that Yonah is pretty active on Facebook, and that's how I've been following him and found him because we are connected through lots of mutual friends, and he's been pretty helpful on Facebook as well. So how did you get into cost segregation space personally? Of course, the business or the company has been around for a while.
Sure. Yeah. The company has been around for about 15 years, Madison SPECS. But personally, I got involved about close to 3 years ago. Okay. Really was looking for something in the real estate space. I had been a commercial mortgage broker.
You were? Oh, okay. Real estate then.
Exactly. And a little bit of a residential broker for a little while. And, I did a few fix and flips and, wanted to get in the investing side as much as possible. But at the same time, I saw I'd lost money on the fix and flip.
Yeah, we all do, right? We all do that. Those are educational, right?
Exactly. So you learn quickly that you got to find something a little more steady and something to kind of help you to get into. And then I found multifamily and commercial real estate was so much better.
Scalability.
Exactly. For so many reasons, which I'm sure you've talked about plenty of times on your podcast.
Of course.
And this kind of role allows me to be in touch with everyone, and in every market and in every type of deal that's out there. And so it's given me a tremendous education just being connected with so many people.
Right. I think, you'll be pretty much connected with all the large operators, big syndicators, etc. Because anyone who is buying large multifamily building, hotel building, mobile home parks, whatnot, they would be looking at cost segregation, right? So
exactly.
So define cost segregation for us now.
Right. So it's a weird name. Right. It's a weird name, right? So cost segregation. Okay, we're segregating out the cost. Let's break it down. Cost segregation has to do with depreciation. And depreciation is probably the best tax tool that's out there, a tax savings that the IRS gives you for owning a property. For buying a real estate property, what they do is they say, guess what? You can now write off the entire value of that building over a long period of time. So for residential or multifamily, it's on over 27 and a half years. Exactly. So you can take that $1 million property you bought, subtract a certain amount for land. Land does not depreciate. And then you take the rest as a tax write-off, literally. You just write it off your income tax.
I tell my listeners that itself is a great advantage, right? Not even thinking about cost segregation, which you will define.
For sure. So cost segregation is like a more advanced and accelerated version of depreciation. What it allows you to do is to break down the building into different components.
Oh, I see.
and identify everything that actually, according to the IRS guidelines, depreciates on a faster schedule, a faster scale. And then identifying those things, you can now take the write-off of that value on a faster schedule. So the cost of the building, right? We're segregating those costs, so to speak. And it's a weird name. I don't know why.
Yeah.
Right?
We don't like segregation.
Yeah, exactly. Exactly. This is the only type of segregation we're talking about here. But what it is really, it's component depreciation is really a better term for it. And it used to be called that, actually. And again, this weird name. So what we're doing is depreciating each component of the property on its own proper schedule. So for example, personal property, or things that are in the building, in the property that are not part of the structural component of the building, depreciate on a 5-year schedule, which means you can take the entire value, add up all those things, all the furniture, all the appliances, all the fixtures, all the millwork, window treatments, like curtains and stuff like that. Any little thing, right? Behind you see that mirror, right? If anyone's looking on the YouTube, that's considered furniture object. That if you can add up all the value of those things, that you can now write all that off over 5 years, as opposed to lumping it all together over the 27 years. So that's essentially what cost segregation is.
So basically, you are able to separate out the walls, right? The structure from everything inside it, right?
Right.
Okay.
And our engineers, our IRS requires you to have engineers come and identify what those things are. We create this, very detailed report, which will break down every type of asset and say, on what schedule is that on, and then what's the square footage? What's, how much square footage of carpeting do you have in that property? The carpeting depreciates over 5 years. Now you can take that amount, apply a value to that, okay? Because it's actually difficult to do. And that's why you need engineers to do this.
Right, of course.
When you're building a new property, okay, exactly the costs of every asset that's going in there, right? You have the invoices, you have everything there. But when you're buying an existing property, it's very difficult to know, how much value should I apply to the cabinets? Okay, they've been here for, they were installed 12 years ago. What's the value of that? It's not, and it's an amazing thing. The day you buy the property is when that depreciation starts over for you as the buyer, based on what you paid for it, which is an incredible thing if you think about it.
Oh, wow.
Not based on what the actual
value of that,
what the lifespan of it is, right? You say, what do you mean? How much value does this roof have left on it, right? It's was built in 1974, right? No, the bank will say, your roof doesn't have much value to it, and therefore I'm going to appraise it for less because you're going to need to replace that roof in a year from now. But from a tax standpoint, they give you the tax write-off based on what you paid for it today.
Wow, that's amazing.
It's incredible.
So can you give just a small example with numbers? Like, let's say you buy a $10 million property or $1 million. What have you seen? Again, it's just an example. We are not trying to dissect the entire thing here.
Absolutely. Generally speaking, and each type of commercial property is different. Okay, but let's talk about multifamily.
Yeah, let's focus on it.
It's very common. If we're talking about garden style multifamily, right? Not talking about like you would have in New York City, these walk-up buildings on the concrete.
Right. Oh, yeah.
No. Let's talk about, your typical garden style.
C-class. Yeah.
Exactly. $1 million. Okay. And you can extrapolate the numbers based on this. We typically see anywhere between 20 and 35% as what's going to be reallocated to a faster life. Okay, so let's take your $1 million property. Okay, you bought it for $1 million. You have to subtract a certain amount for land. Land does not depreciate.
300, 400, or
15%. No, it's even 15%, 20%. Okay, $200,000, 20% is allocated to land. Our basis, what we can now write off, is called our basis. That's $800,000.
Cost basis,
Your cost basis, exactly. Let's say 20% of that is going to be allocated to that 5-year property, this personal property, and that's pretty common.
Okay.
Not so far out of the way. So 20% of $800,000 is how much?
160.
Exactly. That means you can now take $160,000 of extra depreciation over those first 5 years. So let's break it down, take a step back. If you didn't do cost segregation whatsoever, you would now have, based on that $800,000 cost basis, of a little bit every single year for 27 years would give you a tax write-off of approximately $30,000.
Correct.
And I'm rounding off, but just to give you an idea.
Yeah, pretty close, yeah.
$30,000 is a great tax write-off.
Yeah.
Okay, it means you make $100,000 from your property, $1 million property, net operating income, $100,000, not too impossible. Immediately, you take $30,000, subtract that from your income, you're only taxed on the remaining $70,000.
Right.
What happens if you add extra depreciation right off to that? So that's $160,000 over 5-year period, right? You're talking about an extra $35,000, an extra $40,000 every year. That's going to take your tax write-off right off the top to $70,000. That means your $100,000 income is now only going to be taxed only $30,000 as tax.
That's huge.
So that's pretty. That's the simplest way of understanding it.
Yeah, that's awesome. Thank you for that. So, and also I was reading and I've been following the Tax Cuts and Jobs Act. Did anything change in the TCJA, right? I've been hearing bonus depreciation and whatnot. Does any of that apply into
Yes,
real estate
absolutely.
space?
In fact, huge. This Tax Cuts and Jobs Act made cost segregation extremely beneficial because they introduced a rule called 100% bonus depreciation, right? And people are hearing about this and think it's actually something different than cost segregation. It's not. What it is the IRS now allows you, once you've identified what that property is that depreciates faster, okay, over a 5-year schedule or a 15-year schedule, it now allows you to write all that off in the first year, meaning you can take that entire amount of 5-year property, a 15-year property, and instead of waiting and spreading it out over 5 years, let's take our example, that $160,000 of tax write-off. Instead of spreading it over 5 years, you can now take that entire thing and write it off in year number 1. That's called 100% bonus depreciation.
That's amazing.
Yeah, it's crazy. It's incredible.
So, and I have some questions, right? So let's say I'm a passive investor and have invested about 100 grand in a multifamily syndication, right? So would cost segregation loss float into me, right? A passive loss, and how would that work? Yes, excellent question. So investing passively in a syndication would usually give you what's called an LP investment, a limited partnership, which would give you equity in the deal. Okay, that equity comes along with the tax benefits that come with it. So if you have, according to your amount of investment, however much that is, in terms of the percentage of ownership, the percentage of equity, that's going to be your shares of depreciation, of tax write-off. So let's say in our example of $100,000 investment in $1 million equity. Okay, so you're taking 10%. Your $100,000 is creating, 10% in this $1 million property that we gave our example of. Well, it's not a perfect example because $1 million of equity is not necessarily going to be the same as $1 million property, but just for our intents and purposes, let's say it's 10% of the depreciation. So if your property gets in the first year $100,000 of depreciation, okay, then you would get $10,000 of that depreciation, 10% of that. Got it.
Now, just to understand how that works, okay, because it's used, you get this on your K-1, which is a tax form which shows what your income is and what your depreciation, what your write-off is. So you're going to always want to look on what is that income. So now on a $100,000 investment, you may be getting, let's say, an 8% return. That's $8,000. Now, getting a $10,000 tax deduction on an $8,000 income, that means that the entire $8,000 that went into your pocket is not taxed. Okay, you don't have to pay taxes up front like your W-2. That goes to your pocket. Not only that, you have a $2,000, not a credit. Okay, it doesn't get as a credit.
It's a passive loss
refund. But it's considered a passive loss, and that carries forward, meaning that stays with you. It carries forward to your next year. It's tax return. And
Yeah, that's the power of real estate, and putting it together with cost segregation. It's amazing because now I can apply it to my passive income as well, right? So I can keep doing this every year, and I can keep applying or carry over that passive loss. So I want to make that clear that it does not apply to your active or W-2 income. Right.
Exactly.
So, because a lot of my investors and listeners always ask, "Oh, can I apply to my earned income?" And I'm like, "I hope, and I wish, but you can't." Right.
So there's certain, depending if a person is in, has a certain threshold of income.
Right.
Then they could apply if they have under $100,000 of adjusted gross income, which if they're investing in a syndication, it's probably unlikely, but it's possible. Okay.
Yeah. Yeah. No,
then they could use a certain amount up to $25,000 to offset their W-2 income. Another thing is that if they're a real estate professional.
I was going there.
Oh, you're going there. Okay, great.
No, it's awesome. Yeah. So the couple of exceptions, right? Real estate professional, and you are working in real estate for more than 750 hours. And more than 50% of your time, then yes, you can apply or take that passive loss against your active income.
Exactly, which means you can now take that extra loss and apply it to your active income as well, or your spouse's, which is great because you don't necessarily have to be that real estate professional. You can be you can have someone that is married to someone who's a real estate professional, and the other one now can get that tax write-off, and use that to apply against both of their incomes. Right. So that's a huge thing.
That's awesome. So another question I have is, what if I don't have enough passive income to write off the passive loss, right? Which is pretty, and again, I think this question should be for a CPA, not for you. Mm-hmm. So is there any limit on how long can I carry forward the loss?
So the loss carries forward with you until you sell the property.
Okay.
So it carries forward, indefinitely,
right,
as long as there is loss, or until you sell the property. So once you sell the property, that's now released and can be used against, to offset other income or other gains. But it's not, it doesn't carry forward after that point.
Got it. And when is paying for cost segregation justified? And this question is also for me as well as a lot of other small investors. Can I do it on a single family house, duplex, fourplex, etc.? Or does it have to be a certain size before I can, justify the, the premium for cost segregation?
100%. So obviously with the actual service of a cost segregation study comes a fee. Now those fees are not contingent to tax savings. However, that fee is going to be, depending on the firm, Madison SPECS, for example, will charge, dependent on the scope of work that's involved, anywhere between, I'd say $4,000 to $7,000 is our typical fee structure.
Okay.
Unless it's like a massively huge property. Now, that being said, the percentage of tax benefit is going to, determine whether that fee is even going to be worthwhile.
Right.
So on a property that's, purchased for under $500,000, to spend $4,000 on a study and then get, let's say, $50,000 of tax benefit, okay, that may be worthwhile for some people, but it may be just, enough that is there really going to be that much benefit there? Now it's going to be an individual question. I'd say over $1 million purchase, it's like a no-brainer. There's so much across the board. It's going to be good as long as you're going to have that, the need to get it done. Because if you don't have those passive, if you don't have income, for example, right? And this is why it's really subjective. Right. If you don't have income, so then it doesn't make sense to get a cost segregation study to create more deductions when you don't even have income that can be used for.
And go ahead, sorry.
Yeah, but I was going to say that it doesn't necessarily have to do with what type of property it is. Okay, a single family, duplex, fourplex, it could be a small retail property. It doesn't matter. It's really more based on the purchase price, which is going to determine what that cost basis is and how much can be, what percentage, how much can be reallocated.
Got it. And when should someone involve a cost segregation company like Madison SPECS? During due diligence or after close, and why? Sure.
So it can be done actually retroactively as well, but most people reach out during due diligence stage, during, once the property's gone under contract, they're looking at to get it done. The study itself only needs to be completed before you file taxes. Okay. For that year. So if you buy a property today, right, in February of 2020, this property's taxes are going to be for 2020 taxes. You have until next year, March, to get it done, or April to get it done. However, it does take some time to actually do the study, usually 6 to 8 weeks. So you want to plan accordingly, not to wait till the last minute to get it done. So that's why a lot of people reach out for us to run the numbers, which is something we do complimentary, at no cost, just to run like an estimate and our projections of what your tax benefits are going to be if you do a full study. That being said, it can actually be done retroactively as well, meaning let's say you may not be making any money on this property, for the first year. It's going to be, a gut job or whatever it's going to be. You may want to look at a cost segregation, a year or 2 years, 3 years down the road, and you can get those tax benefits retroactively. That accelerated depreciation that you could have taken, you can now claim that in the first year that you are doing the cost segregation without having to amend any tax returns. So it's a great way, for kind of tax planning to figure out, hey, when am I going to be making money on this property? When is it going to make sense to do it? And then it may not be in the first year.
That's amazing, because that was going to be my next question, that let's say if I can't do it in first year, can I do it in fourth year, right? But you already answered that. So
perfect.
I'm going to change the topic now. So I have pretty much enjoyed the cost segregation side. Do you personally invest in real estate, and what kind of real estate?
Yeah, so like I mentioned at the beginning, I did some fix and flips and realized quickly that was not for me. I currently am investing in multifamily deals, and I think, large kind of multifamily deals, 100 units and more. And I'm looking personally to get involved, very heavily in actual, operations and ownership of that. I'm kind of shifting in my, pivoting, if you will, into doing that as well. I'm not stopping the conservation thing, but I see a lot of opportunities out there, and I think, now's really the time.
That's awesome. So, and now I have started to ask this question to all the guests pretty much. So where do you see market is headed in the next 2 to 3 years? Because everyone is talking about impending recession. This is the longest expansion cycle in the history, blah, 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 right?
Right. Right. So, and you're right. I think the reason why everyone's saying that is because it's just a fact. I mean, it is the longest history. It is, the longest expansion. A lot of people are saying it's going to be, contracting, and there's going to be a recession, et cetera. I've been hearing that consistently for the last 3 years.
Me too.
It's going to happen in the next, next year, right? For sure. And so I think investing conservatively, and investing in properties that are, more or less, or quote unquote recession proof, are going to be much more advantageous. So there very may well be a recession. Right. And we have no idea what might cause that. It's just historically, that's what keeps happening in a certain cycle. So you have to prepare for that to come inevitably, when that may be. We don't know what's going to cause it. But that being said, if you can invest conservatively, not too high leverage, for example, and investing in properties that can withstand a recession, like workforce housing and things like that people need a place to put over their head no matter what. Right. I think that's gonna be a more conservative investment.
That's great. So any real estate or business apps or websites you can't live without?
I think Zoom, this one right here.
Oh yeah, I love Zoom. Yeah,
I love Zoom. It's incredible. I definitely cannot live. I mean, obviously, could live without it, but it has done tremendous amount for my. I mean, this is the second of 4 Zoom calls I have scheduled for today.
Oh wow! Okay.
So, right. It's something that's it's really a game changer. Also LinkedIn, believe it or not. You see me active on Facebook and groups there, but I'm much more active on LinkedIn.
Oh, really? Okay.
Extremely active on that platform, creating content, on a daily basis and connecting a lot of people together. So it's something that's really also done tremendous amount for me and my business.
Yeah, and so great point. So I have not been as active on LinkedIn, but I met Gary Vaynerchuk at one of the event, and that's what he was talking about. He said
Yeah,
LinkedIn is the next platform. That's where
exactly.
a lot of people would be focusing, right? So yeah, thank you for that as well. So any business or real estate book you recommend?
Recommend a real estate book. I think, you know what? I'm reading right now a book by Hunter Thompson. He just
Oh
put
yeah,
out
I
a
know
book a
Hunter
couple
is a
months
good
ago.
friend.
Yeah, so he just put out a book.
It's syndication book, right? Yeah.
Exactly. It's called Raising Capital,
Yes.
or the Capital Raising, something like that.
Yes, something. Yes.
We have actually a group that we put together, a bunch of guys, called like a Raising Capital for Real Estate. That's what it's called. We have like a mastermind group that's reading it together and meeting once every other week on like a Zoom call, just like this, about 10 people, 12
That's
people,
awesome.
something like that. And each one is reviewing a chapter, bringing out points, and asking questions. So it's actually been a pretty fun experience. The first time I've ever like done like a book club type that, where we're actually reading a book together and reviewing it and discussing it. So that's been cool.
That's awesome. How can my listeners reach out to you?
You can find me on LinkedIn if you haven't already. You can find me on Facebook. Right, there's not too many Yonah Weisses out there. I don't think. If there are any.
Not many. I don't know any.
I don't know any either. You can leave my email in the show notes if you have that. Weiss at madisonspecs.com. So that's my email. Best way to reach out to me. And happy to provide anyone follow-up discussion or a free estimate for anyone's property if they would like to hear more about what cost segregation could do for you.
That's awesome. Thank you so much, Yonah.
My pleasure. Yeah, thank you so much, Alpesh. It's been fun.
Absolutely. We'll do this again.
I hope so. Yeah, it's gonna be. We could actually do one next after we close our first deal.
Yes, that's the goal, right? Then we can drill down into the real numbers, right?
Exactly.
Have a great day.
Okay. Thank you.